401ks are an excellent retirement planning tool. They basically allow you to invest and build wealth in a tax advantage space, meaning you don't pay taxes on contributions or withdrawals depending if you go Roth or traditional. And earnings are also allowed to grow without any sort of tax implication. Now that said, 401ks are set up as part of the Internal Revenue Code, and anything the government sets up, it's going to be more complicated than it has to be. The bad news is for companies and custodians who have to manage these plans, this creates a bit of an administrative cost that's passed on to us who are actually investing in the accounts. But the good news is this also creates a lot of other tax wrinkles and loopholes and hacks that we can use and employ to maximize and optimize the benefits of 401k plans. So in no particular order, here are my 8 favorite 401k hacks to help you take your 401k plan to the next level. The first hack is the 401k match from your employer. Granted, there may be some debate as to whether or not this qualifies as a hack. It's not as if it's a great secret, but what isn't debatable is how valuable a 401k match is from your employer. First of all, it's free money. It doesn't matter if they're matching dollar for dollar up to a certain percentage of your income or if they're only matching a percentage of what you contribute. Either way, it's money that you otherwise wouldn't have that they give to you absolutely free. Now, needless to say, if you have a dollar for dollar match, that's doubling the amount that you contribute to the account, which is obviously very valuable. So much so, in fact, that we have the employer match as milestone number 2 on our Next Dollar roadmap. The only justification I can think of for not actually taking advantage of an employer match is if you have zero cash, no way to support yourself through any sort of emergency or monetary hiccup that might come your way. In that case, you should have a small reserve of cash before you contribute to an employer match. But employer match is very high on the priority list financially. Number 2 is 401k rollovers. Now, technically, we could have made this 5 hacks in one because there's a lot of different ways you can roll money in a 401k plan. Within the plan itself, you can roll it out of the 401k plan into an IRA. The first one we'll talk about is rolling an old 401k into a new 401k. There's several reasons you might want to do this. The first one is you may just want simplicity and have all of your 401ks in one plan. Another is to take advantage of the rule of 55. If you have assets in an old 401k, you won't be able to use the rule of 55 to withdraw those early unless they're in the plan that you actually have when you retire from your employer. And finally, you may want to roll your old 401k into a new one because your current plan is actually better in terms of investment options, expenses, and things like this. If it just offers more flexibility and is a more capable plan for you, you might want to combine them all into that plan so you have more flexibility. A second option is to roll a traditional IRA into your 401k to clear the road for backdoor Roth IRA contributions. If you have a high income and a large traditional IRA balance and you thought about doing a backdoor Roth IRA, then you probably also know about the pro rata rule, which means you'll have to pay taxes on a proportional basis of your traditional IRA or untaxed IRA assets to your Roth assets whenever you make that conversion. So if you have half and half, that means half of the amount you convert from a traditional IRA into a Roth IRA is going to be subject to income tax. Well, if you move your traditional IRA into your 401k, then that means there are no untaxed IRA assets, meaning if you make an after-tax IRA contribution, you can just convert that into the Roth and not have any income tax liability from the conversion. A third option is if your 401k plan allows for in-service distributions, you could take money out of your 401k and move it into an IRA. And the reason you might want to do that is if your 401k plan has limited options for investments, or it's expensive, or there's some other aspect of the plan that you just don't like, you can move it into an IRA where you have a lot more flexibility about investment options that you choose. There's just a higher degree, I guess, of control when it's in an IRA versus a 401k. The fourth reason for a rollover is also an in-service distribution, but to clear the way for mega backdoor Roth IRA contributions. That's actually a strategy we're going to talk about more in a second. But having the ability to make an in-service distribution from your 401k to an IRA kind of clears the road for that. Not all plans allow it. That's why it's kind of valuable. That's why we're highlighting it. Be sure to check your plan summary description to understand whether or not that's something that's available to you. Finally, after you separate employment from the employer that sponsors your 401k plan, it's generally more flexible or easier if you take the 401k and roll it into an IRA for several reasons. One we already talked about. There's more flexibility in an IRA to choose the assets, investments, and things like that you want. But you can also make Roth conversions from a traditional IRA that you can't do from the 401k into a Roth IRA. You have to take additional step of taking 401k assets, put them in a traditional IRA, then convert them to the Roth IRA. Also, if you want to make qualified charitable distributions, you'll have to have that money in a traditional IRA. You can't do that from a 401k. So moving the money from your 401k to an IRA also clears the way for you to do some charitable giving. It also has some tax advantages. Number 3 is the mega backdoor Roth. We mentioned a minute ago that we would come to this. You may know that in 2024, an IRA maximum contribution is $7,000 if you're under 50 years old. If you're 50 or older, it's $8,000. But using the mega backdoor Roth IRA strategy, you could contribute potentially up to $69,000 into a Roth account in 2024, or $76,500 if you're 50 or older. So here's how the mega backdoor Roth works. So you have up to $23,000 of tax advantage contributions you can make on an employee basis to your 401k each year. That's $30,500 in 2024 if you're 50 and older. There's actually an upper limit of $69,000 and $76,500 for your 401k on an after-tax basis combined with your employer contribution. So really, if your plan allows, you can contribute that delta from your contribution, your employer contribution, and everything up to $69,000 or $76,500 on an after-tax basis into your 401k account. Once those after-tax funds are in your 401k, you can either convert them within the 401k to a Roth, or you can roll them out of the Roth into a Roth IRA using an in-service distribution like we talked about a second ago. This means you could potentially get up to $69,000 or even $76,500 if you're 50 or older into a Roth IRA or Roth 401k in 2024. Number 4 is to use a solo 401k. Now, solo 401k works much like a regular 401k you'd have if you're an employee working for a large employer. The contribution limits are the same for you. The total, that $69,000 or $76,500 total max contribution is also the same, but the difference is solo 401k is for a small business owner without any employees. You can make contributions to that as the employee and as the employer, meaning you can contribute up to that larger $69,000 or $76,500 limit each year. Now, the employer contribution is limited to 25% of your business's net self-employment income for the year. So if you had $100,000 of net self-employment income, only $25,000 is what you can contribute to your solo 401k for that year as the employer. You also need to keep in mind that if you have a 401k at a normal employer and then you have a solo 401k on your own, that first $23,000 or $30,500 if you're 50 or older is limited in aggregate for all of your 401k plans. So you couldn't make a $23,000 contribution at your, say, standard 40-hour-a-week job and then have a side hustle with a solo 401k and contribute another $23,000 there. On the other hand, each plan gets its own employer contribution. So you could make employer after-tax contributions on your employer-sponsored plan in a normal job. Then in your solo 401k, make employer contributions only up to that $69,000 or $76,500 limit in your solo 401k. So you could potentially double them up if you had access to two plans. Also, if you're married, your spouse, if they work in the business and receive income from the business, they can also participate in your solo 401k. But that's where it stops. You can't have other employees that are eligible to participate in the solo 401k and contribute to the plan yourself. You could also use a solo 401k for that mega backdoor Roth we were talking about a second ago and just do it through your solo 401k instead of an employer-sponsored plan. Finally, you can set up a solo 401k with nearly any investment company or brokerage. A lot of them have different options, features, fees, and things like that. You need to look into that before you set one up. You want to make sure that you choose a plan that has the features you want to accommodate different strategies and things you want to use through your solo 401k. Hey, if this information is helpful to you, you can show your appreciation by clicking like and subscribe below. It helps our channel to grow. It also will allow me to keep making videos about personal finance so I can help educate people to help them make good decisions about their investments. Hack number 5 is the rule of 55. So if you have an employer-sponsored retirement plan like a 401k or 403b, you probably know that you cannot make withdrawals from those accounts until age 59.5 without paying an early withdrawal penalty. There is, however, an exception to this known as the rule of 55, which basically allows you to begin making withdrawals from your 401k when you reach age 55. Now, we touched on this just a bit earlier. Basically, the way it works is you can begin making withdrawals from your 401k plan once you sever employment, either because of a layoff or because you retire. And you can begin making penalty-free withdrawals from the plan that was sponsored by the employer you retired or severed service from. It does not work for old 401k plans. It only works from the one that's held by the employer that you're leaving. Now, you can roll an old 401k into your current 401k and then take advantage of the rule of 55 by combining those accounts, and basically the old plan will inherit the flexibility of the new one and treat it as if it's all one plan that basically is held at the employer that you're leaving. Now, you can't retire before age 55 and begin using the rule of 55 once you reach age 55. You can use the rule of 55 when you reach age 56, 57, 58, anywhere in there, but you cannot start it before age 55. Hack number 6 is called 72T distributions, or series of equal periodic payments. It's pretty similar to the rule of 55, only there is no age limit or restriction on it. Basically, it's an agreement with the IRS. They're going to allow you to begin making withdrawals from your 401k before age 59.5 without any early withdrawal penalties, but you have to take the same calculated amount or use the same calculation to pull that amount out of your 401k each year until you reach age 59.5, or 5 years have elapsed, whichever occurs later. So if you start taking 72T distributions at age 51, you'll have to keep it up until age 59.5. If you start at age, say, 57, you'll have to keep it up until age 62. There are 3 different ways you can calculate a 72T distribution. There's the amortization method, the annuity factor method, and the minimum distribution method. They are pretty complex, so we always recommend reaching out to a tax professional to help you calculate those so you pull the right amounts out and don't wind up with a costly penalty. Hack number 7 is to use Roth or traditional 401k contributions. Now, as of the end of 2023, around 90% of 401k plans allow for either Roth or traditional 401k contributions. Originally, 401k plans were traditional only or tax deferred only. Starting in around 2006, 401k plans began allowing Roth contributions, and slowly plans have begun to adopt that, where nearly all plans allow it now. And the advantage of that is it allows you to choose when you pay tax on your 401k contributions. Either you can pay tax when you pull money out of the account through the traditional or tax-deferred contribution, meaning you get a deduction when you put money into the account, but when you retire and make withdrawals, all withdrawals are subject to income tax. On the other hand, a Roth, you pay tax when you put the money in the account, but then it grows completely tax-free and all your withdrawals are tax-free in retirement. Now, which one is better than the other really depends on your tax situation when you make a deposit or make a contribution versus when you make withdrawals in retirement. If you think your income will be higher in retirement than it is now, it makes sense to go ahead and make a Roth contribution because you'll pay a lower tax now and a lower income tax bracket than when you make withdrawals in retirement. Those would be tax-free. On the other hand, if your income's pretty high now, you probably want to make a traditional contribution because you get a tax deduction now, but in retirement, when you make a withdrawal, you'll be paying tax at a lower rate. If your income is the same both when you make a contribution and when you make a withdrawal, then neither Roth nor traditional has an advantage over the other. Just the way the math works, the compounding interest and the tax on the front end and the back end, it's all a wash. Generally, if your combined state and federal income taxes are below 25%, Roth is generally going to be a better option for you. If your combined federal and state taxes are over 30%, traditional is probably the way to go. And if you're in that 25 to 30 range, it really just depends, but you can actually do both. You can make some contributions Roth, some traditional, kind of hedge your bets. That's always a good option as well. But typically it boils down to preference. Do you want the government to be the silent partner in your retirement plan, or do you want to go ahead and buy them out as you're making contributions? It's a personal choice. It's up to you. There's not really a right or wrong answer. Hack number 8 is to choose low expense investments. So when you make investment choices in your 401k plan, usually you're going to have some sort of name or abbreviation for an investment, mutual fund, whatever, some sort of description that may or may not tell you a lot about the investment option. And usually there's going to be an expense ratio listed in a column off to the side of all those different investment options. Hopefully there is anyway. You need to pay attention to those expense ratios. Generally they're going to range anywhere from tenths of a percent all the way up to 2%, although there are some that are all the way up to 5%, which is absolutely crazy. But you need to pay attention to that. Over time, even small differences in the expense ratios can make a huge impact in your portfolio's value. Recently, I actually wrote a post about this. We posted on our website, martinmoney.com. We showed how 0.9% difference in expense ratio over the course of 35 years could make around $120,000 difference in the value of a portfolio. We've got a graph on your screen now to illustrate the difference in cost in two identical investments over time with that subtle difference. Again, that's 0.9% difference in expenses. Personally, I would lean toward low-cost index funds as you choose investments within a 401k account. The irony of actively managed funds is not that they really perform necessarily any worse than index funds. It's that they cost money to operate because there are people who are doing analysis, they're making trades, they're paying taxes for those trades, there's expenses and costs for those trades. Those people have to eat, they have families to feed. So they charge an administrative fee for actually operating or running the mutual fund. Index funds miss a lot of that because they only follow an index. There's not a lot of active involvement in people actually having to manage the account, so they're a lot cheaper. So I hope this information is helpful to you. Even if you don't use the hacks we've gone over in this video, I hope you'll use a 401k account if you have access to it. Just the tax advantages alone makes it worth your while. And like we said from the outset, if you have an employer match, that's hard to beat. It's just free money, so go get it. For more about 401k plans, you can check out our YouTube channel. We actually have a playlist dedicated just to 401k plans. There's more on our website at martinmoney.com. As always, we are thankful and grateful for your interest in our videos. God bless and take care.